Jamie, let's talk about taxes and your global investments. A lot of Canadian investors are finally waking up to the potential of investing in global markets, but there's a question: what is the most tax-effective place to make a global investment? Is it your RSP, a TFSA, or a taxable account?
Yeah, it will really depend on those global investments, the nature of them, and in particular whether or not they pay dividends. Because again, we get into an issue of withholding tax.
Okay.
And if there's a withholding tax on that global dividend, obviously if it's in a TFSA, you've lost it permanently. So that investment is not really tax-free if you've lost the withholding.
Okay.
If it's in an RSP, again, you lose the withholding tax. So a lower amount goes into the RSP, and so you have a lower amount that's compounding, tax-free. If it's in a non-registered account, you do pay full tax. You get a credit, however, for the withholding tax against your Canadian tax liability.
All right, so anything global that pays a dividend, best to have it in a taxable account.
Yeah, I would say so. If you're going to hold it across all your asset classes, right, then yeah, you get your full current tax credit there. That being said, is it really a big cost, depending on the ratio of dividends to other holdings?
Okay, we're talking about the optimum place is the taxable account, but people may want to have global content in their RSPs and TFSA for diversification purposes. You just have to recognize you're not quite getting the whole dividend.
Well, that's right. I mean, you're actually losing 15% of the dividend, but if the dividend is relatively small, 2 or 3%, and you're losing 30 to 45 basis points, again, you're not paying tax on that because it's not going to come out ultimately as taxable, then there may be a benefit actually to keeping those in the RSP.
Thanks, Jamie.
Sure.